John Toohig is the head of whole loan trading at Raymond James and president at Raymond James Mortgage Company. He is also a widely followed market commentator and conference speaker, known for his LinkedIn presence and his weekly Let's Talk Loans newsletter, where he breaks down what's trading and trending in today's lending markets. John, thank you for joining me.
I'm glad to be here.
Before we dive into the specific questions that I've got for you, can you unpack what exactly whole loan trading is? I know that a lot of it is implied in the name,
right.
The picture.
It's a great question. We often wonder why we say whole loan instead of just loan trading.
Right.
The idea is it is trading the loan, the unsecuritized loan. Mm-hmm. So imagine no tranching, no structuring, no rating agency. We are literally packaging the loan or a group of those loans from a bank, a credit union, an insurance company, a finance company that might be originating and selling it to another counterparty. That simple.
I got two questions actually. Is there something that drew you particularly to whole loan trading specifically, or did you just kind of find yourself
So I started in securitization when I was with Morgan Keegan, even First Horizon before that in the early 2000s. We were packaging and selling loans to Fannie and Freddie, the GSEs, in bulk. Through that, a package of auto loans came across our desk. Well, that can't go to the GSEs. And we asked the question, well, we could still package and sell those loans. Why not? So we did. And through that, we did kind of what for us was one of the first whole loan transactions in the auto space. We were also doing auto ABS. So we were securitizing auto loans and putting them into ABS transactions. And we started to look at what are the positives and negatives between doing a whole loan sale or doing a securitization. We then kind of expanded that into mortgages, we expanded that into commercial loans, we expanded that into HELOCs, and then just realized that anything that's on a bank's balance sheet could be sold or securitized. So it's just a different form of liquidity, it's a different practice and process. It's a little maybe less strenuous than doing an ABS or an RMBS deal, a little bit more simple, if you would.
That leads into my next question. I was going to ask, what are the benefits, or do you perceive as the benefits of whole loan trading?
It's faster. Generally speaking, a trade takes 30 to 45 days to complete. You still have your due diligence, you still have your legal contract. It's kind of like buying a house. You have a buyer and a seller, and you have a contract in the middle, and there's some due diligence done to it. There's servicing that goes back and forth, so there's some coordination on that. There's usually not a rating agency. There's usually not trustees. There's usually not accounting opinions and whatnot. So maybe a securitization light, if you will, process. And usually maybe a stepping stone towards somebody who might want to securitize. If you do a couple of whole loan transactions, you have to have all your policies and procedures and your underwriting guidelines and your servicing policies all kind of well documented, and maybe have some investor reporting done that would give maybe someone wanting to take that step into the larger world of securitization. It's a good foundation for that.
I got you. So what do you think, when you look at the entirety of the mortgage market today, what do you think they're the top, one or two factors or things that loan originators misunderstand about how capital markets work that are driving their loans?
Sure. I think the biggest challenge for them is we're kind of coming off the sugar high of 2021 and 2022. We all enjoyed a $4 trillion origination market and refinancing and everything. We're stuck now with a lot of those 3% 30-year fixed rate forever loans. So originators today are kind of having to reinvent themselves into a myriad of different products, whether that be HELOCs, HELOans, HEI, more purchase money, non-QM. If you're a loan officer today, you really have to have a real large Rolodex of products to be able to serve your customer. I think that's a big piece to what the secondary market is. We look at loan officers and we think, okay, I'd like to offer my customer a HELOC, but I don't know that I could sell it. I don't know that I have a back end, a liquidity source for it. So maybe that's not a tool in my tool bag that I want to use as a loan officer or somebody on the front lines. I think that's the benefit on my side, is I can see where those liquidity sources are, and we communicate that down to the originators and tell them to source that because we have a place and a home for it.
Right. So if there's an LO that's sitting, this is a kind of, I don't know, this is an outdated term of a rate sheet, but if there's an LO sitting down with the buyer this week and they're trying to explain really what's driving the rate sheet, and from your opinion, is it more, from the Fed? Is it the 10 years? Is it spreads? I know it's a combination of things, obviously, but what's the most important factor that you see right now?
I mean, the Fed is obviously a huge piece of everything. The GSEs and everything that they have. I mean, let's just use ARM pricing. The GSEs have been notoriously horrible for pricing ARMs. Depositories have not been. Depositories usually like to own ARMs because they're shorter duration products. Yeah. So if you are that loan officer and you're working with your management team, do they have a diversity of source of places for it? Now, the Fed plays a piece in that, the 10-year plays a piece in that, secondary markets plays a piece, all that kind of comes together. It's a tough question to answer specifically, but it's all about where that back end liquidity is coming from.
What about signals that people that are working on lock desks or pipeline managers, what signals should they be looking for this year?
That's the 1 o'clock conversation later today. We have your panel this afternoon, and I'm sure that's going to be one of the things is, what are the big topics for 2026? I mean, never waste a good crisis. Washington, D.C. has an affordability issue that's going to be on the voting docket this year. I think, getting advantageous stuff coming out of Washington can help legislature that could help supply right now. I think we have plenty of, we need units. We need to stimulate builders. We need to put more units on there to get home prices down. Obviously, we'd love to have 3% 30-year fixed rates again. I think that'll be a while before we see that. I think watching Washington and hopefully getting some good policy coming out of Washington would be huge for the mortgage market.
If you had a magic lever to pull, or you could pull any lever, let's say, what would be the one that you pulled to stimulate that growth and that building, that construction?
You've got a number of things. You can talk about zoning. You can talk about tax credits to builders. Builders got wiped out really in 2008, and they've come back. Those are probably the two biggest issues in unlocking some of those problem points. I also have to look at housing isn't just a Dallas thing. Yeah. We're here in Dallas today. It's a national thing. We need more housing in kind of that middle belt of income, the everyday American, right? We don't necessarily always need jumbo stimulus. We don't always necessarily need low-income housing. We need kind of that middle band, as studies have shown. If we can help unlock some of that supply, I think that would be useful.
You mentioned this a bit earlier, but how have you seen the wants and needs in investor portfolios from, QM, non-QM, jumbo, HELOCs, home equity? How has that shifted over the past year, and what do you think originators and lenders should be leaning into or pulling back as a result?
So if you think of our trading volumes on the Raymond James desk, 2021 was 22 were just incredible years, $9 billion traded in each of those given years. And then when rates went up to us late 22 and early 23, we went from a $9 billion trading year to a $400 million trading year in mortgages.
Okay.
Wow.
Yeah.
I mean, that's like almost completely turning the spigot off.
Right.
That was not to do with credit. It was simply we went from a 3% mortgage rate to a 7% mortgage rate, and banks had duration become an issue for them, and they just didn't want to own mortgages. So that was a huge liquidity suck for most of the originators out there. Is where do we make and put these loans? It's kind of a shunned product, if you will. Fast forward 2 more years now, banks are back. They're doing ARMs again, and you've seen ARM origination go up. 30-year fixed rates still out there. So in 1 to 4 family, first lien originations, ARMs and fixed rates coming out of the banking industry is a positive. It's not a drag on originations. I think the piece that I've been beating the drum on for a very long time are HELOCs. We've got $14 trillion of trapped equity out there. 40% of all homes are owned with no lien associated with it. Most all homes have strong equity in them these days, certainly any home originated before 2021. If you're a loan officer today or you're a mortgage company today that doesn't have a HELOC, a closed-end second, you need to be looking into that because originations there have been rising, and I think will continue to rise even if mortgage rates drop another 100, 150 basis points.
Where do you think? Where's that equity? Let me see the best way to phrase this. That equity trapped in, as far as age demographics. Like for the reverse mortgage space,
right.
Let's say, like how much of that is for the 62 and up crowd that would be better suited perhaps for a HECM versus a HELOC
Sure.
versus the.
HECMs have a bit of a negative slant to them, right?
Sure.
You know, your borrower has to die before you get your equity back, right? Yeah. Depositories can sometimes be hesitant to lean into that particular, but right now it has tremendous use case. I mean, you can certainly understand why that particular corner of the market has been doing well, much like a HELOC would. So I think having more of the product for HELOCs and HELOans as maybe that younger demographic education and getting rid of that negative stigma on HECMs and reverse mortgages is something I think we continue to kind of work through.
Do you see ARMS still carrying that stigma from 2008?
No.
That's interesting, right?
Well, as a child of the 2008 mortgage crisis, underwriting and mortgage is too clean. Let's just start there across the board. Any product we've talked about, mortgage credit is too hard, too solid, too good. We joke in 2008, if you had a pulse or you could fog a mirror, you could get a loan, right? That's so far from the truth today in underwriting. It's already almost hard to even think about how those loans were made in 2005. You can say the same thing for HELOCs today. We aren't making 125% loan to value, 600 FICO, no income, no asset originations anymore. It doesn't exist. HELOCs today are 770 FICOs on 85% combined loan to values on full doc loans.
Right.
It'd be all right if we loosened mortgage credit just a smidge.
Right.
I don't think we'd break the world if we did that.
So I was going to ask, you've traded through multiple cycles, ups and downs. What does, I think people are, Sarah and Logan talk a lot about this, Logan specifically, on HousingWire Daily about like the new normal.
Yeah.
What do you think that looks like in today's market, and what does not look normal yet to you that you think LO should be looking out for?
Specific to mortgage.
Yeah.
The new normal is super clean, pristine, triple underwritten loans with third-party underwriters, with very, very tight and very few exceptions made assets. That's the opposite was true back in the 2000s, right? You'd get in through a file and you just never knew what you'd get. You would think it was a full doc loan and it was an alt doc loan or a NINA or a CISA or whatever. So a lot of focus, obviously. Subprime crisis created a lot of issues back in 2008, but the pendulum has swung too far. You're going to get a very complete document that's been looked at by not only the originator, but a third-party originator, and then whoever buys it. So 3 sets of eyes are going to go through any loan file today, and you would be pressed to find too many variances associated with it.
This next question, I think you kind of just touched on it in your previous answer, but for most people that don't live in the secondary market, in the world of trading loans, what simple framework would you give them to understand why some deals are easy to place and while others are much harder to sell?
The negative to 2014 in Dodd-Frank is, if I say Fannie Mae 30-year fixed rate, most everybody understand what that box is. We've splintered. There's not a standard as much anymore. You've got JP Morgan doing JP Morgan things. You've got Redwood Trust doing Redwood Trust things. You've got various mortgage companies that are originating loans that are more QM. But if you look at non-QM, debt service coverage ratio, asset depletion, there's a host of different kind of ITIN loans, different flavors.
Right.
Different investors have different interests and different flavors. Let's just pick on ITIN loans right now. Individuals that could be U.S. citizens but have tax ID numbers, et cetera. Because of the current administration, when it was the Biden administration, that was a very friendly immigration. So people wanted everything they could get on that. This administration is a little less friendly towards immigration. So, that is something that maybe is cooling off a little bit. There's a certain investor that'll take that risk as opposed to somebody who won't. Debt service coverage ratio loans, had, I think, their best year ever this
Yeah.
year since 2014.
We've written a lot about them this past year.
And rocking. Those spreads have really tightened in, and multiple bids for those portfolios when they come out, which means there's good, strong.
And that trickles
liquidity
down
flow.
into pricing and overlays and guidelines all
Correct.
across the board.
Tighter spreads usually means lower coupons. Lower coupons usually mean more originations. More originations mean loan officers are excited about being able to offer that product.
So what loan, again, kind of folding back to our last answer, our previous answer, what loan structure are you seeing is the easiest to move in the whole loan market, and which ones are drawing more scrutiny besides the foreign national
30-year
loan?
fixed rate is going to always be the easiest understood. It's the most widespread. It's been with us all the way back. So again, to answer your question, to whom am I selling? To a bank, a 30-year fixed rate, or an adjustable rate mortgage? No problem. To private credit, they're looking for a little bit more juice. They're looking for something that's probably wider in spreads. They might be willing to take a little bit more risk. They might be willing to lean into a higher LTV or a lower FICO score because they want a wider spread. They have a higher return. HELOCs right now, and I say HELOCs, I have to think of closed seconds, and I haven't quite trained my brain to do that.
Yeah.
Most everybody wants a HELOC. It's easily the hottest product out there, secondary market trading. If you can find somebody who's originating HELOCs in the market today, it will sell.
So whenever you're looking at the things that are harder to sell or harder to move, is there any specific combination of factors from product to credit profile or property type that draws more red flags or scrutiny
Let's pick
than
on
others?
one that's popular,
Okay.
but hard to sell.
Okay.
Doctor loans.
Really?
Originators love to make a doctor loan, and it's usually a low down payment, and they're usually trying to catch somebody right out of med school. And when I say doctors, I could mean lawyers, professional loans, right? So usually cash poor individuals, because they're right out of med school, right out of law school, and they're starting their practice, so they can't afford the down payment, but the bank, usually a depository, wants to originate them because they want to develop a relationship with them. So not only do they get their mortgage, they get their business credit card, they get their business office, they get their kind of total banking relationship. So maybe the mortgage is a loss leader going into more fingers in the pie that are the customer, right? But it's a 97% loan to value or a 90% loan to value on somebody who's cash poor and doesn't have a lot of reserves. And the seller doesn't really want to give away the servicing because he wants to maintain the relationship with the borrower. And he really wants the borrower to be 10 years from now when he's established his practice and he's got good, steady cash flow. So I can't sell the servicing. I've got low reserves and I've got a high loan to value profile. And I probably have a coupon that's commensurate with a 30-year fixed rate today. I'm not getting extra yield for the juice.
Right.
That's going to be a loan that lives on a balance sheet, but it's not going to be a loan that's going to be very easy to trade in the secondary market unless somebody sees the benefit along the way.
Where do you see the most practical opportunity for originators in the next year to year and a half?
HELOCs,
all
loans,
day.
Seconds, maybe even HEI. HEI is kind of starting to have a moment again. If you remember 2008 and Brex loans and things like that, there was some interesting bits to that. I'm not totally convinced on HEI, but seconds and trapped equity, I think, are where we are.
From your experience, what separates originators, or lenders rather, that consistently close better quality loans, that are easier to sell, that have no buybacks, et cetera, from the ones that don't?
Process, having your documents in order, streamlining those documents. When we look at the diligence part of trading, if somebody's loan files aren't well organized, well indexed, well scanned, well imaged, well reviewed, somebody's not going to want to buy them again. That's becoming less and less of an issue. Not too long ago, it was pretty common for us to trade loans in paper form, right? I mean, really only in the last 10 years have we seen kind of the digitization of the mortgage and an imaged PDF file through Adobe where you've got everything. But that quality scan job, that quality underwrite, good solid documentation and underwriting, well sourced, is a real winner for getting somebody to want to come back and buy more of your loans.
So I know that you spend a lot of time looking at your performance and delinquencies, and prepayments. What is the data telling you right now about borrower behavior, and how should that shape the way that loan originators are advising their clients, but also they're constantly worried about timing the market, specifically or correctly?
As I look at all asset classes, because I'm usually talking to CEOs and heads of lending, there's been a lot written about commercial real estate and how commercial real estate's kind of having a really tough year. If you look at the numbers for the last year and a half on mortgage, particularly current coupons, 6-7%, delinquencies aren't kind. Now, overall, I want to say very clearly the mortgage market's in a lovely spot. 3% mortgages, $1,200 a month payments really has been one of the reasons we dug our way out of COVID and the consumer's doing well. But the delinquency numbers for 24 and 25 vintage of 7% mortgages where you have a $2,400 a month payment instead of a $1,200 a month payment, that's eating in to the consumer. So delinquencies are higher, maybe not necessarily alarmingly so. So there's a real race to see those loans refi out and get to lower payments. That comes back to the whole affordability conversation a little while ago, and how and why we might be worried about that particular subsize of the mortgage market today.
Is that something that you anticipated, though, kind of going into?
You have to think that, right? I mean, you and I we're making our payments every month, and there's, the wages aren't growing as fast as we're spending it, right? So you got to cut back somewhere.
Right.
That's certainly, I think, something that Washington is watching as well.
Excellent. John, thank you so much for joining us.
Absolutely.
It was a pleasure.
Yeah, thank you.
Thanks, sir.